Efforts to pressure the Federal Reserve into lowering interest rates through aggressive tariff policy have met resistance from within the central bank itself. Even among those traditionally in favor of easing monetary policy, new tariffs are being seen not as an economic boost, but as a roadblock to rate reductions. Former President Donald Trump has once again called on the Federal Reserve to lower its benchmark rate, citing the high cost of servicing the United States national debt. With federal debt now totaling approximately $36 trillion, each percentage point of interest adds hundreds of billions in annual debt servicing costs. Trump argues that a rate cut would provide substantial fiscal relief. At the same time, he has floated sweeping new tariffs, up to 50%, on imports from countries like Canada and Brazil, presenting them as tools to support domestic manufacturing and economic growth. Yet, these proposals are being challenged from within the federal, notably, Austan Goolsbee, president of the Federal Reserve Bank of Chicago and one of the more dovish voices on monetary policy, has publicly warned that the new tariffs could worsen inflationary pressures. According to Goolsbee, tariffs function as price shocks. They raise costs on imported goods which quickly filter into consumer prices. In one recent example, tariffs on Brazilian soybeans and beef caused supermarket prices to surge by 30% in some areas, sparking widespread concerns among consumers. These price increases are not just immediate, they are also anticipatory. Many households, seeing new tariffs on the horizon, began stockpiling goods, further distorting demand. Businesses, too, are rushing to build inventories before tariffs take full effect, amplifying price volatility. In response, the Federal Reserve is now facing a complex dilemma. If it cuts rates to ease debt burdens and support growth, it risks stoking inflation that tariffs have already helped ignite. But holding rates steady may slow economic activity, particularly in interest-sensitive sectors like housing. The central bank's internal divisions are becoming more apparent. One camp, led by the San Francisco Fed, argues that the inflationary effects of tariffs are temporary and that rate cuts are still viable. A more hawkish group, including officials at the St. Louis Fed, maintains that the inflation risk is real and persistent, possibly extending through 2026. Meanwhile, a large number of Federal Open Market Committee members remain undecided, preferring to wait for clearer signals and economic data. As of the latest projections, 7 out of 19 policymakers have withdrawn their support for any rate cuts this year. Federal Reserve Chair Jerome Powell recently acknowledged that absent the tariff-related inflation pressures, rate reductions would likely have already taken place. The probability of a cut in July has now dropped to below 7%. This underscores a broader point. Attempts to manipulate the Fed's actions through trade policy may be producing unintended consequences. At the heart of the matter lies a contradiction. Tariffs are being used to encourage domestic investment and bring down unemployment, but their side effect is to raise consumer prices. That, in turn, makes the Federal Reserve more cautious about easing policy. The cycle becomes self-defeating. Political efforts to stimulate the economy run up against the economic realities of inflation and debt sustainability. The national debt continues to grow, driven in part by expansive fiscal policies in recent years. Even large-scale legislation designed to support industry and infrastructure has added over $3 trillion to federal liabilities. While a lower interest rate could ease the government's borrowing costs, it is not a panacea. For most households, the hoped for relief, lower mortgage rates, cheaper credit, remains elusive. Meanwhile, wage growth has struggled to keep pace with price increases exacerbated by tariffs. As new trade measures are introduced at regular intervals, often every 6 weeks, inflation expectations remain volatile. Goolsbee has compared the situation to driving blindfolded, an unpredictable course with too much at stake for ordinary consumers. While political influence over central banking has been attempted before, the Federal Reserve has signaled that it will continue to guard its independence. As one senior official recently stated, any attempt to politicize monetary policy would be met with firm resistance. As for whether there will be a rate cut in September, markets, analysts, and voters alike are watching closely. The answer may ultimately depend not just on data, but on whether the trade policy cycle stabilizes or continues to inject uncertainty into the economic outlook.